Good afternoon and welcome to the Council of New Jersey Grantmakers webinar on the new nonprofit accounting rules announced by the Financial Accounting Standards Bureau, otherwise known as FASB. We are delighted to have Chris Peterman, who is a CPA and partner and director of philanthropic and private foundation services at PKF O'Connor Davies, to help explain these new rules that funders should know about. Without any further ado, let me introduce Chris to walk us through these changes. Take it away, Chris.
All right, thanks, Craig. Appreciate it. Hopefully everybody can hear me. A lot of fun doing a webinar here. Our phones and internet went down about a half hour ago, but fortunately I have my cell phone. So let's get going. So, Craig, we're going to be on page 2 of the thing, and hopefully it's entitled FASB, Financial Accounting Standards Board, ASU number 216-14, Presentation of Financial Statements of Not-for-Profit Entities. So this is a big deal in the exempt world, because the last time that there was any sort of changes to exempt organizations nearly as pervasive as this was back in 1996, 1997, when they came out with what was then known as 116 and 117. That's 116 and 117. And could we please mute that one line out there?
I'm working on it. There we are. I think we're okay now.
Perfect. So 116 and 117, which set up net asset accounting as we now know it, and actually this will slightly undo net asset accounting, as well as give definition to contribution recognition, which we're still living with. But this is a really big deal, and the main areas that we're going to talk about are net asset classification, as I mentioned, financial performance detail, and then cash flow and liquidity disclosures, which I think are probably some of the most important things that are in here.
Chris, I'm sorry to interrupt. We're getting a bit of an echo on the line. Is there something, if you can take yourself off speakerphone, that might help.
Okay. Is it better now?
Much, much better. Thank you.
Good. Sorry about that. So the effective date for this is calendar year entities that end December 31st, 2018. So I guess the sort of good news on this is that we have time to digest it. We have time to look at it. What we'll talk about here today is a first crack, and I'm sure as we get closer and closer, we'll be having most participants here will be having the opportunity to either hear me or other people talk about this at their board meetings and whatnot. But it's good to know that it's coming. For fiscal year entities, because a lot of fiscal year entities will be affected as well, it would be mostly their June 30, 2019 year end. So basically year end December 31, 2018, and then the fiscal years that end after that. So as we're now entering the 2016 reporting season, we have a solid 2 years ahead of us, which is good because there's a lot of changes, and it will require all exempt organizations, including all of those on the phone. Now, today we're going to focus from a foundation standpoint what to look for, what's going to look different. But in actuality, some of our participants today, actually all of our participants today, will also be internally affected, although not with all of the parameters here. Particularly a lot of our grant makers on the call don't really have much net asset classification issue, which is the first thing we're going to talk about. As we move to slide 3 and 4, we see that we have really 8 areas that we're going to focus on today. And the first one will allow us to really jump to slide 5 at this point. And this is called the simplification of net asset reporting. Okay, so if we look at slide 5, we see on the left-hand side current GAAP, and then on the right-hand side we see the new ASU, or Accounting Standards Update here. Currently, our net assets are reported, when I say ours, I'm referring to all exempt organizations. I'll just use the possessive there, in three categories: unrestricted net assets, which, as it implicates, the name implicates, are assets free of restriction, which most of the grant makers on the call, because I got a list, and some of you I know and some of you I don't know, but most of you, a bulk of the vast majority of your assets are in that category of unrestricted net assets. But many of your grantees have significant amounts of temporarily restricted net assets, which are assets restricted going forward by either time or usage. And sometimes those restrictions are set by you, the grant makers, as well as government contracts and whatnot. And then permanently restricted net assets, which are those assets which we would generally call an endowment fund, in terms of those assets where the corpus is permanently restricted and the entity can use the income generated from those assets for, again, a designated purpose, but the corpus of those is restricted. So now over the past few years with some changes, and I should give a little background, is that the FASB has been working on this project for a solid 5 years. And, you know, as those of you who know me from board meetings, we've been talking about this for probably 2 years in board meetings, because the first draft of this was issued a year and a half ago. And it was a very comprehensive program, and it was put out in actually August of 2015 to the community, to all, you know, to a bunch of folks for comment. And the comments that came back were so spirited and well-intentioned that the FASB broke it up into 2 project areas, because they realized they were sort of biting off more than they can chew. And what we're talking about here today is the first of those 2 project areas. And it's really the easier items. At the end, I'll spend just a second talking about things that may be coming down the road, but that's going to be a ways off. So we have these 3 net asset categories, and they're saying, you know what, because many organizations over the years have had some difficulty actually discerning between what's temporarily restricted and what's permanently restricted. Sometimes the documentation given or left behind with a contribution, many times through an estate or even some of the documentation, is not fully clear as to the indication of whether it's truly temporary or permanent. We've seen instances where clients where organizations have moved an asset from the permanent to the temporary, or the temporary to the permanent, as they've gained a little more knowledge and done a little more research. So what the FASB has done, as we look to the right side of slide 5, and you see the little lines, they've taken the temporarily restricted and permanently restricted and just called those net assets with donor restriction, and the others are net assets without donor restriction. So it's a little simpler in the terminology, and actually I think, they talk about this being simplification, and I think they've actually done it. It's very clear. Now, there will still be footnote disclosures and sort of fund accounting beneath these levels of restriction, but I think, personally, I think it's going to make it a lot easier for the users. But as you being a user of these upcoming financial statements, things are going to look different. So that's, I think certainly one of the big things that we see coming down the pike with this. One other thing, I think one of the other drivers here is after the financial crisis of 2007, 2008, we saw a lot of permanently restricted net asset funds fall underwater, especially newly created ones, and that gave rise to guidance that said, you know what, because a lot of organizations sort of panicked, said we're underwater in our corpus, and we're not going to be able to draw anything on that. But guidance was given that as long as your draws are reasonable in terms of investment, prudent investment management, you can still draw on those permanently restricted funds because they're going to kind of go up and go down over time. That also, I think, gave rise to why they're sort of doing away with the temporarily and permanently restricted nomenclature, because things weren't as permanent as one might have thought. Okay. With that, I'd probably like to move forward to slide 6 at this point, so we can also talk about some breakouts within these two categories. So there will be, I mentioned that there'll still be disclosures as to what makes up these. So we're not just going to stick with those without donor restrictions. So many organizations, many charities have their undesignated or their truly unrestricted money, undesignated here in the example, for operations. And then many times boards will create their own, what we would call a quasi-endowment, their own board-designated reserves. You could call it a rainy day reserve, you could call it endowment, but it's internally restricted. And those designations will be required to be made, and you'll see how they'll come into play a little bit later when we talk about liquidity. But this will now be disclosures that could either be on the face of the balance sheet or probably in the footnote. And to keep the balance sheet a little cleaner, I'm going to imagine that people will start be putting them in the footnotes, similarly to the way right now people have their temporarily and permanently restricted funds listed separately in the footnotes. But here's just some, again, some broad use of what may be a plant reserve, a property and equipment reserve, and then, as I mentioned, a quasi-endowment, a board-designated endowment. You could have a board-designated operating reserve that could be, a lot of organizations like to set that aside. So they may say, you know what, we want to take 3 months of our operations and we're going to put it in a board-designated reserve so we can track our unrestricted reserve separate and apart from that. And that would be disclosed here, which, again, this is all important. As users of the financial statement, you're trying to evaluate the fiscal health of this organization, which is really, I guess I should have prefaced, that's what this whole process is in helping the grantors evaluate the fiscal health of their grantees. Before I move, Craig, I just want to make sure we don't have any questions before I move into the next topic, which is underwater endowment.
We're good right now.
Good. So moving forward to underwater endowments, currently, and again, here we have, so we're on slide 7 for those who are following along in that manner, or as Craig, as you move the slides forward or backwards. We're only going forwards right now. It's hard to have humor in a webinar, but we'll try. So we have, on the left side, again, we have current GAAP, and on the right side, we have what's going to be proposed. So currently, if a permanently restricted net asset went underwater, it would be taken out of the unrestricted part of an organization's net assets. So now going forward, though, the guidance is that will now not be funded out of the unrestricted. It will be tracked separately in the fund, sort of where it emanated from. And it's interesting because some of this is we're going backwards. Those of us old enough to have been around for fund accounting, that's sort of the way this stuff used to get tracked. And in many respects, we're going back to that. So now if a fund goes underwater, it's going to stay in that endowment. With donor restrictions, will be absorbing that loss. And you see here the way this example is designated is there was a $10,000 loss, which reduced the unrestricted assets to $3,923,000. Under the new standard, that would be $3,933,000 in the without donor restriction, or the unrestricted under the old nomenclature, and that loss would be reflected in the donor restricted area. So that, again, that's another change that we'll be looking at. As we move forward to slide 8, you'll say, well, that's going to muddy the waters there. But what will be in the disclosures along with that will be the aggregate amount of the original gifts. So you'll see what the original gifts of all those permanently restricted things are and what their current fair value is, as well as I think one of the important things is we're going to be seeing a lot more discussion in the financial statements. And this is one of the first places we're going to see it. So there'll be a disclosure on what the board policy or actions taken concerning the appropriation of such funds. What's the plan if it's underwater? What's the organization plan with that? Okay. So that brings us up to the fourth area here, which is the elimination. Currently, people who get gifts to fund property, plant, or equipment, those gifts are released as it's expended, as the money is expended, and then it continues to be released over the useful life of the asset. So if in this case, in our example here, if a donor gave $20,000 to an organization, if one of you gave $20,000 to an organization to buy computers that were deemed to have a value of 5 years, a useful life, not a value, a useful life of 5 years, that contribution would be recognized over the useful life of the purchase of the assets, sort of as they're purchased and amortized. Going forward, it's going to be fully recorded in the year that the donation is made. Okay, so in a sense, those of you who are private foundations out there, and certainly those of you who are my clients that are private foundations, know that as a foundation, when you, at least for your tax purposes, when you buy something, you could buy $1 million building. It goes towards your 5%, right? Which is the big number there, which is your current number. It goes towards your 5%, and this is sort of mimicking that in GAAP, in that the whole contribution in that year that it's made for a major purchase will be recognized in that year of purchase, as opposed to, let's say somebody gave $1 million contribution to buy a building, which would be recognized over, say, 39 and a half years, which is a common life for an asset such as a building. It's now going to be all recognized in the without donor restriction in the year that it's received. So that's yet another newbie that's a new point that's going to be coming out, and again, a slight change. So that's interesting. I think the next part, slide 10, starts a really interesting, and perhaps to the people on this call will be the most interesting part and the most significant change, other than the net asset change. I mean, that will make the balance sheets look different. There's probably 3 areas of what we're talking about today that I think are most important, but I think this next area is very important because one of the big things is to expand the disclosure of the assessment of liquidity and availability of resources. And a lot of times when we speak with our grant-making clients, I many times use the analogy that a program officer at a foundation is many times like a loan officer at a bank, okay? Because you're trying to assess, certainly program impact and a lot of other things, but you're trying to assess to make sure that the money that you're giving is going to certainly go to the project that you're funding, right? And making sure that an organization has appropriate liquidity, I think, is a big step in getting to that direction, that the money that's being given is going to go specifically to that project, and somebody's not taking that money to pay somebody else's project or somebody else's debt along those lines. And this is really the first time that we're going to see some real enhanced disclosure. And And if we forward to slide 11, this is just an example note of that actually, I wish I could take credit for this, but this was given to us by the FASB, and it's really interesting because it's going well beyond the numbers. And here it talks about how a make-believe nonprofit is substantially supported by restricted contributions. And because the donors requires resources in a particular manner, they must maintain, significant resources. And the financial aspects may not be available, for general expenditure within 1 year. So the whole point of this this footnote is to help the user of the financial statement understand the organization's ability to meet its current needs 1 year out. After it backs out all of its obligations or restrictions of money that may exceed a year. For example, many times we'll see an organization that may have a very healthy-looking balance sheet, but in fact, those assets that are it may have really large net assets, or in this case now, asset contributions without donor restriction, but they could be tied up in non-liquid assets. And what's going to happen now is the financial statements will have both narrative as well as we're going to get to numeric disclosure that will help you as the users of the financial statement sort of do what you may already be doing in your head, but help you evaluate the cash flow and the liquidity and position of the organization. So if we move forward to page 12, we'll continue along this line. And so the financial statements are going to communicate the quantitative information regarding the availability of financial assets to meet the general expenditures of the organization within the next year. Financial assets not being property, plant, and equipment, or prepaid expenses, things along those lines, being receivables, grants receivable, within a year, cash, obviously, near cash, and investments. But we're going to see the example when we move forward, but backing out the restrictions that are already existing on them, be they external limitations imposed by donors, laws, or contracts, or be they internal limitations imposed by a governing body such as the board. Remember earlier we were talking about board-designated funds, a board setting up a rainy day fund, a board setting up a property, plant, and equipment fund, to perhaps, start to set up money to replace. I always look at, replacing a roof or replacing a boiler or replacing a building or doing major repairs, things that have been set aside on an internal nature, and then also the nature of the asset itself. Do we have to back that out? So this is important as a first cut to see, exactly what the liquidity situation of an organization will be. So if we move forth to slide number 13, we have a little example here. So here, a hypothetical organization had financial assets at the end of the year of $234,000, right? But we're gonna, and this is gonna actually be a disclosure that will be part of the footnotes. So the organization will then have to say, well, less those unavailable for general expenditures within 1 year because there were contractual or donor-imposed limitations. And in this case, we had a restriction by donor with time or purpose restriction, okay, what used to be, what currently is deemed to be a temporarily restricted net asset, so we have to back that out. And then we have another restriction subject to appropriation and satisfaction of donor restriction. In this case, there's another $174,000 that needs to meet certain satisfactions. Some of the investments that are listed in the financial assets are held in an annuity trust, so they're not available for liquidity right now. Board designations. We talked about this earlier. A quasi-endowment was set up by the board in this case for long-term investing, so we'd have to back that out. And amounts set aside as a liquidity reserve that the board had decided to set out. So we're backing that out in this in this example. So that, in fact, while if you look just at the balance sheet and you say, oh, look, they got $234,000 in the bank, at that point in time, they really only had $5,000 potentially to meet the cash flow needs for general expenditures within the next year. So I think this is going to be a very meaningful statement and disclosure to grantors, to lenders, to anybody trying to evaluate the ability for an organization to move forward. Just the other day, I was at a presentation about going concern, and starting this year in FASB land, in my land as an auditor, up until now, to give a going concern, a clean opinion assumes that the organization is going to be viable for another year. So that if you're looking at an audit report that has a clean opinion, you should have a slight warm and fuzzy feeling that the auditors feel that it could be this organization be viable for another year. Under the current standards that we're currently operating under, that would be from the year of the balance sheet date. Starting this audit season going forward, that's going to change to the opinion date that the accountants render. And this is really interesting because a tactic that some organizations have used in the past is they've said, okay, give us a draft, because we don't know if we're going to, the organizations that are sort of on the line, give us a draft, we'll send it to our funders, and then when we get, to 11 months, you guys can sign, then the auditors say, well, we'll sign the opinion because we've seen you've already made it. But that's going to change because now they're going to have to make that assessment. Management's going to have to make that assessment, and the auditors are going to have to sign off on that assessment from 12 months to the opinion date, not from the date of the balance sheet. So if the balance sheet was dated December 31st, 2015, but the auditors didn't sign it till December 1st, 2016, that's where the 12-month clock is going to start going forward. So I think that's going to change a little bit for those organizations that are on the cusp, and many of us out there, end up funding organizations that are on the cusp. But it's important to know, and I think this is probably the most valuable disclosure and valuable change in the new standards that will be coming down. So this is actually pretty neat, and I think a real positive. If we move forth to page 14 or slide 14, we have a minor tweak. Currently, investment expenses are something that are required to be a line item in the financial statements, and then footnotes of the financial statements. But they're no longer going to be required to be identified as a line item. Investment expense, not interest, investment expense. And investment return is going to be reflected as net of investment expenses going forth in financial statements. That is something that, particularly in the grant-making community, hello? In your yes, hello. Sorry. Craig?
Keep going.
Okay. I just want to make sure I didn't lose everybody.
No, you're fine.
Okay. So so investment return will be shown net of investment expense. Could always disclose it, but that's a little change. Second, I said there were really three areas that I thought were important. The first one we discussed, which was the delineation of net assets in the three categories. The second one we just discussed, which was the sort of the liquidity discussion, which I think is really insightful. And then, we'll give management an opportunity. One thing I should mention is management will then also have the opportunity, if their liquidity looks bad, well, they'll also be able to put in there, yes, but we also have access to a line of credit, which would be disclosed in another part of the financial statement, but it will give management an opportunity to talk about their liquidity and really bring up a discussion. The third part that I think is really important and really neat, and many of your organizations do it, and this is something that will actually impact the private foundations out there that report under GAAP, okay, is that currently only voluntary health and welfare organizations are required to report their expenses on a functional basis. And slide 15 starts our discussion of what current GAAP requirements are there, okay, which just basically says that you have to break them out between programmatic, management in general, and fundraising, okay. But if we move forth to slide 16 or page 16, we'll see that it's a much more robust disclosure of how those expenses are to be categorized. In other words, we are now going to be disclosing not only by function, but by nature of the expenses, okay? So all expenses will be put across a grid. And many organizations, you may be used to seeing this already, and I mean, I'm sure you probably are with some organizations, but all organizations, including foundations, will now be required to break out their expenses by programs, and I know some of you do that already based on, some of the special things that you may be doing, be they direct charitable activities or, in your grant-making activities, and then management in general, and then fundraising. Now, most private foundations will not be having fundraising expenses, but this is clearly for your grantees. This is going to be a very meaningful statement, because not only will you see the breakouts in total, but you'll see them by the functional area, by the functional classification of, how the salaries are broken out, how the travel is broken out, and it gives, again, a lot more transparency and drill down disclosure to these statements. And I think it's clearly a case here where more information will be very valuable and will help you in assess how your grantees are running their organizations, where their money's going, and what's flowing into those various buckets. But again, as I mentioned, this is something that not only will be affecting your grantees, but will be affecting you as well. So that's really an important thing. The sort of last area of major change that's coming down is in the statement of cash flows. And again, those of you who've had the misfortune to listen to me before know that I'm not a big fan, certainly for foundations, of the statement of cash flows, because really, you're, as a foundation, you're an organization that's dealing with almost all cash or near cash items. So cash flows isn't that meaningful to you. However, to many of your the nonprofits that you fund, it is meaningful, and it's also an area to measure liquidity. Currently, it's being done by almost all. It's in almost all financial statements done in what we call the indirect method, and the indirect method of doing the cash flow basically takes your balance sheet accounts from year 1 to year 2, takes the difference of them, and puts a few other adjustments into it. It does break out your cash flow into a couple of different methods, mainly from operations, from investing, and from financing areas. But it's not that meaningful, even for many of your grantees. The other method of doing it is known as the direct method. And the direct method of cash flows is a much more meaningful methodology of putting out the statement. One of the reasons that many organizations didn't do it in the past is if you were going to do the direct method, you also had to do the indirect method. So it was a lot of work. Now the direct method will show more in terms of the full flows, the flows into the organization from contributions, the flows out of the organization by expenses. It could be, flows in from investments and flows out from investments as we have now. But it's much more meaningful to users of the statement. But since you had to still do the indirect as well, it was way time consuming, and nobody was doing it that way. The change in the standards now allows you to choose the direct method without doing the indirect method as well. So we have already seen some clients adopting the direct method of preparation. It also happens to be a little harder and requires a little more work, certainly from management in terms of the buckets that they keep their information in. But we feel that it is much more meaningful, and we see a move for many people to move in that direction at this point. A couple of other notes here, again, to reiterate that the effective date for all of these changes is December 31st, 2018 reporting periods and then thereafter. Early adoption of this is permitted. We've seen early adoption of some of the other pronouncements, but a lot of these changes are so pronounced, and we've already seen some different adaptations and interpretations of these. We are basically not suggesting to our client base to go for early adoption. One of the other reasons is in the year of adoption, you have to do all of the provisions that are, so you can't just say, we're going to change our net assets. If you're going to early adopt, you have to change everything. It's by far the most sweeping changes in exempt organization reporting in 20 years. So we're seeing most organizations, and we're sort of counseling our clients to take more of a wait-and-see approach, maybe let some of the big folks, the really big fund, grantees out there, the major national organizations, take a leap forward on this and see what it's looking like. But we've already seen, some changes in the minutia, the absolute guidance on this as to where it's going to go, which is another reason not to. And to do it in a comparative basis, you're certainly going to need a 2-year lead time on this to start getting your accounting system set up to track the information accordingly. So again, that's merely an opinion that we've been given out, but we don't see people running to early adopt this because this is the most heavy lifting in any change that we've seen come in quite some time. You heard me mention earlier that there were some other areas that the FASB originally was going to incorporate this, and I'm now on slide 18 where it says Phase 2, because everything I was talking about here was Phase 1. And the other areas that they got a lot of feedback on was they wanted to put in operating measures and in the financial statements. So, operating measures for, say, hospitals or operating measures for schools. But there was a lot of feedback on what should they be, what should be included, what shouldn't be included, and they were having a real hard time getting true traction on that, which I think is one of the main reasons they broke it out into a separate phase, because these items that we just discussed were more uniformly adoptable and where people were in greater concurrence that, these are all good things. Operating measures were a little more challenging, as you might imagine, as well as talking about realigning certain items in the statement of cash flows, which has given them lots of diverse feedback in that area. So those will be coming in the future. One other area that I actually thought of just the other day, and it's not in my deck here, is leases. There is a change of lease accounting, and effective not this year, but in 2017, years after 2017, there will be a change in operating lease accounting. Currently, operating leases are only treated as a footnote disclosure, but from that point forward, the full amount of the lease, so let's say we enter into a 10-year lease for $1 million over that 10-year period, that's going to be put on the balance sheet as a lease liability at the $1 million marked up to its present value. So let's say, for lack of a better, that the present value of the 10-year lease is $800,000. It will be put on the balance sheet as a $800,000 lease payable, and also on the balance sheet as an asset as an $800,000 lease. The purpose, the thought here, so you're saying, well, it really doesn't have any effect on the, and will have no effect on the P&L, but the liability will be on the balance sheet. And the idea here is, I still think this is really, the lease discussion has been going on for a solid 10 years, and it's still a trickle-down effect from the Enron off-balance sheet accounting issues that we had way back when Enron failed. So it's a matter of, even though operating leases were disclosed in the footnotes, nobody saw them as a liability on the balance sheet. And the idea is to get as many liabilities onto the balance sheet as possible, so that they're, some people would say, well, I don't really look at the footnotes that much, although those of us who deal with financials on a pretty regular basis think the footnotes are pretty important. So that's sort of the extent of my soliloquy here, and I'm certainly open to any questions now or at another time, because I think my contact information is listed in here. But I basically I know I went through this reasonably quickly, and hopefully if you're eating a sandwich while you're doing this, I gave you enough time to finish. But I'm open to questions, and thank you for allowing me to go through this with you.
Thank you, Chris. What we'll do is I will unmute all of your lines. So if you do have a question that you would like to voice, by all means go ahead and do so. Otherwise, if you wanted to also do it through the chat window.
The conference has been unmuted.
Go ahead and please use the chat window as well. Any questions?
This is Nina. I don't have a question, but I just want to thank Chris so much, because once again, your exceptional experience is enormously valuable to all of us. So I just really want to thank you and all the good work that O'Connor Davies, is it PKF O'Connor Davies?
It is PKF O'Connor Davies.
Great.
Just keep changing the name.
But, well, thank you, and it's always a terrific presentation. But I just wanted to get that in while I had a chance, and hopefully there'll be some questions from folks.
Thanks for having me, Nina. Always a pleasure.
Chris, the one question that I had was, when you talked about operating measures, are we actually talking about outcomes for the organization? That's what FASB was thinking of doing?
Well, I think in terms of
else?
operating measures, I wasn't in the room, but I think we're talking about, ratios and what makes sense for, is if it's sort of like an S&P 500, if you're monitoring your portfolio, okay? So, is the net income per patient at a hospital in line? Here's the national average, and here's this hospital's, which is why, it's sort of like, do you use the S&P 500? Do you do the Russell 1000? Do you do the Dow Jones? Everybody, depending on what your investment style is, has a different measure. Do you do a FTSE? So that's why this has been pushed back on a back burner. And now, honestly, there's a lot of material here for people to absorb and for organizations to get their books up to measure with. So But what we're seeing is a move towards, it's interesting, in some ways simplification, and it's a combination of simplification and transparency at the same time. And operating measures is just, it's also like we have an operating measure of, we'll say we want program services to be at least 75% of an organization's total of its total functional expenses, right? That's an operating measure. But where those measures will come from and how they'll be generated is a real problem.
Thank you. Any other questions from the people listening in? Okay. Then, Chris, again, thank you for this very thorough and really good, important information. Certainly do appreciate that. We will post this webinar on the website. You can see Chris's contact information here. If you want to contact him with any further questions, please do so. And as you finish wrapping up the webinar, as you exit the system, please do complete the evaluation when you leave, and please look at cnjg.org/events for the list of our upcoming programs and register for any of those that interest you. Thank you very much, and have a wonderful rest of today.
Thanks, Craig.